Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at three big reasons why NVDA may finally be a buy, getting paid to be patient with an out of the money put credit spread. And as we always like to do, we like to use our fusion approach, combining fundamental, technical, and IV analysis to find the edge, then put on the hedge. So let's jump in and take a look, shall we? First of all, from a valuation perspective, you can see NVIDIA, the simple PE ratio, right, now trading at basically just off the lowest multiple we have seen over the past 12 months, right? We've had better than expected earnings in the past 3 quarters, yet the stock is down in that time frame. Better earnings and lower stock price lead to cheaper valuation multiples. So certainly NVIDIA, which back here was a little pricey, no doubt, starting to look more attractive and approaching that level in mid-April that signified, as we'll take a look in a second, a short-term low in the stock. You can see longer term because of the expectations for the AI benefit, right? You can see earnings out in 2028 and 2029 certainly will attract some attention and some buyers on further weakness in NVIDIA. We also like to take a look at the technicals and certainly major support at that 170 level, to say the least, on NVIDIA has bounced off of there numerous times, right? Has held basically since it broke out to the upside when AI mania, if you will, was just getting going, right? You can see the stock, which had been basically overbought up here, now getting oversold, but finally showing a little bit of strength, right? As RSI, which had reached about the lowest level we have seen in a while, right? Finally starting to show some strength. MACD didn't reach the depths that we've seen before. Bollinger percent B didn't quite go negative, but starting to strengthen as well. And you can see the stock hovering right around that 20-day moving average. So looking for it to hold on to the support here longer term, right? And the stock, which, as we said, beat earnings nicely, right, as you can see here, yet sold off sharply as it wasn't quite enough. But at some point, buyers, I think, will step in simply because of the expectations of earnings continuing to grow. And you can see the last time the valuation multiple, that PE, was at this level here, right? So going back, it was back in this time, right, when we were looking at a PE under 35, right? We're approaching that as well. You can see that marked a significant short-term low in NVIDIA right before the liftoff here. So certainly the technicals supportive of at least being a buyer on further weakness, and that's what our put spread sets up certainly. So our actual trade is based on IV as well. Here's the implied volatility on NVIDIA. You can see you had a little bit of that normal post-earnings vol crush, right? But not a lot, right? Because of the market weakness, we see implied volatility hanging in there for the most part. IV still elevated, and from Monday to Tuesday's close, you can see IV moved up even more here. Taking a look at it, here's the earnings IV, right, hovering right around that kind of 48-ish level. Right now, we're still at 44, so I've not had that normal sort of tomahawk chop, vol crush post earnings that we see. Higher implied volatility means you can get a bigger credit for the same amount out of the money, or it can get further out of the money for the same net credit, or kind of where we're at, combining the two, get a little bit bigger credit, a little more margin of safety. That's what our spread that we'll take a look at in a second hopes to accomplish here. And interesting that put call differential, right? That the puts, the skew, right, is at an extreme as well. Now over 9 vol points different, as the nervousness is to the downside, which again favors selling those out of the money put spreads, right? You get an even bigger benefit of IV. Also, that skew normally signifies a high level of nervousness, which contrarian opinion is a signal of a low as well, right? The old Warren Buffett adage, be greedy when others are fearful, certainly applies to IV. So jumping in and taking a look at our trade idea, very straightforward, simple, out of the money put credit spread going out to the traditional Aprils, selling the 165 puts, buying the 160 puts, getting $1.15 or so net credit with the stock right at the 180 level where it closed. You can see IV on the puts at around 50, so certainly a rich IV to say the least in NVDA. Taking a look at some of the metrics on the trade, if we bring in at $115 for each spread we sell by selling it at $1.15, our max risk, right, because it's 5-point wide, $385, right, $500 max less the 115 you bring in, so the most you can lose is 385. So a nice risk return, right? Return on risk of almost 30%. Plus, you have 15 more points of downside cushion. That's on a stock that, as we said, has been absolutely taken out to the woodshed post earnings. Certainly well off the highs back here, hovering right at support. So you still have a nice downside cushion of over 8% with only 44 days to go to expiration. So hopefully provide some insight how we go about identifying trade opportunities here and how we go about to structure the trades. But as we always like to say, trading is all about probability, not certainty. So make sure you position size accordingly and make sure you have your exits in place beforehand. So until next time, as always, here's the good trading. Take